Welcome to another episode of the Real Estate Market Minute. My mission is to help you better understand the latest trends in the U.S. real estate market and share with you my analysis and industry expertise. I want to help you gain an advantage and feel confident whenever you're buying and selling real estate. I'm your host, Mark Salib. I'm a passionate real estate professional, advisor, and investor, and I love what I do. Follow and DM me on Instagram at The Salib Group. Send me an email, mark@thesalibgroup.com. And as always, thank you for tuning in to today's show. I am sounding the alarm on inflation and mortgage rates, not because I think the whole economy is falling completely apart, but because this is dangerous territory for a housing market that is extremely sensitive to higher rates. All right, right now you got four things happening at the same time. One is oil is very elevated. The 10-year Treasury yield is rising. And last week we saw Consumer Price Index, CPI, and Producer Price Index, PPI, come in way hotter than expected. Those are two major inflation readings. When you put it all together, it creates a very serious problem for the housing market. Take a look at this. 10-year Treasury yield right now is sitting around 4.6%. That's an extremely high reading. We haven't seen a reading that high in over a year. Brent crude oil is above $109 a barrel. It's up 8% for the week as the Strait of Hormuz concerns remain elevated. And the 30-year fixed mortgage rate, according to Mortgage News Daily's daily index, was around 6.65%. That is a bad combination, folks. And let me tell you something, that latest CPI reading from last week, headline CPI of 3.8% year over year, energy up 17.9% year over year, food up 3.2% year over year. I mean, we're talking inflation is coming back with a vengeance. It is re-accelerating. How about that PPI reading? Right? Producer Price Index. What the producer, the businesses are passing on to the consumers, well, they had to deal with the highest reading in 3 years. That's right, the largest monthly increase since March of 2022. And gasoline alone rose 15.6% in the report. Let me tell you something. PPI, I mean, the businesses, they pay more in the beginning, but I'm telling you right now, these costs are getting pushed down to the consumers. It's already starting to happen, and it's just a matter of time before this gets much, much worse. This is reflation. I said this last week. This is reflation. It's happening. And what I mean by that is inflation had cooled off for a while, but it's clearly heating back up. And look, if oil stays elevated as it has, it just means transportation costs will rise, energy costs will rise, and that ultimately bleeds into the economy. And I want to be clear, I say that, but again, the economy has been very resilient throughout all of this. The job market is still very, very strong. For now, the labor market, we're still at just 4.3% unemployment rate. But this is what you got to watch closely. We know that oil is higher because of the Strait of Hormuz being locked down for quite a long time, limiting and constraining the amount of oil that can come through. And as of right now, and these things are very fluid, but as of right now, there's not a clear resolution. Why do you think oil is still well above $100 a barrel, right? So the market keeps pricing in that risk of there not being a resolution. And quite frankly, the longer this conflict between the U.S. and Iran takes to resolve, the longer the market questions whether oil is flowing freely through the Strait of Hormuz. That's basically what it's doing. It doesn't know. It has to go off of that. And the longer it takes for that to get resolved, well, the harder it is to bet on the housing market for the rest of 2026. Now, again, I'm not saying this is dangerous for the entire U.S. economy. Businesses may still do fine. The stock market may still do fine. Clearly, it's shrugged this off for the most part. Now, I even think some businesses may profit more in an environment like this, believe it or not, because there are very, very good U.S. businesses that pass costs on to the consumer, and the consumer still pays. If an iPhone goes up $50 in cost, the consumer still buys the iPhone, just to give you an example. Now, I know I'm talking about one of the greatest businesses in the world in Apple, but keep that in mind, folks. A lot of businesses, especially the main ones in the stock market that really kind of move the market, in other words, because of their market capitalization being so high, right? They're not going to get hurt much, but consumers will. Consumers will get squeezed. And that's my concern for the housing market. That's my real concern. The danger for the housing market, look, it's sensitive to mortgage rates. Higher inflation. It's going to push up bond yields. It's going to push mortgage rates even higher. Higher rates weaken affordability, and weaker affordability keeps buyers stuck in the mud. Not good for the future of this housing market. And I said this last week too. The issue is not just mortgage payments anymore, in my opinion. I think the whole monthly budget gets hit. I think insurance and property taxes, groceries, gas, utilities, travel, your car payment, your credit card payment, everyday expenses takes a big hit right now, because those inflation reports indicated to me that it's not just oil. It's not just gasoline. Everything went up. Everything went up. So even if a buyer technically qualifies, is that buyer going to feel like they can comfortably afford that mortgage payment along with all of the other monthly expenses they got to deal with? So, this is why I keep saying affordability is the issue. But it's not just about rates anymore. If inflation is pushing everything up, if that whole household budget is being affected, then a buyer's ability to absorb a mortgage payment gets weaker too, not just because of rates. And that's the real danger here. And that's why I'm sounding the alarm. And I'm also sounding the alarm because rate cuts look less likely. Look, I said it here that I have a hard time seeing the Fed rushing into any type of rate cuts this year at all. We may not see a rate cut in 2026. It's tough to justify when inflation goes up this much. And unless inflation cools significantly or unemployment rises meaningfully, well, you're not going to see an impact. Now, there is one thing that could change this quickly. And we've seen this before. If there's a clear shift from the White House that brings the Iran conflict closer to an end and gives the market confidence that oil can flow freely through the Strait of Hormuz, then oil prices could calm, inflation fears could cool, the 10-year could go down and potentially help mortgage rate. But until that happens, you got to keep monitoring this situation very, very, very closely. And look, if you're an investor, I just want you to imagine for a second why I'm sounding the alarm and why I'm so concerned for the housing market, because I know how investors think. And I guarantee you that as an investor, you're going to assume now the following. When you go into an investment, you're going to assume higher financing costs because of higher rates. And you've got to now go in thinking, all right, higher insurance, repairs are going to cost more, utilities are going to cost more, overall maintenance is going to cost more. Oh, and that tenant, can he afford that monthly payment or not? Do I have to lower the rent? A lot to think about, right? So it's tough. It's tough for an investor to go into something that, has all, let's call it all that uncertainty, right? And I talk a lot about this market stress lately because it is what it is. Actually, we did a subscriber only episode, pretty good stuff too. Check it out. How to tell if sellers are becoming more desperate and the signs that I watch for that, such as price cuts and, different things like seller psychology that I get into. You can check that out at realestatemarketminute.supercast.com. Listen to ad-free episodes, and it gives you some bonus episodes too. Look, I'm not sounding the alarm on the economy. I'm sounding the alarm on housing affordability. I'm sounding the alarm on inflation. Inflation is heating back up, folks. Oil is elevated. The 10-year is moving higher, and mortgage rates are back under some serious pressure. It doesn't mean the whole economy collapses. That's not what I'm suggesting at all. But for housing, That's a big deal because unless inflation cools and unless oil risk fades away or rates come down significantly, and I'm talking we need a major policy shift out of Washington, and if we don't get it, the housing market may be stuck for a while here in 2026, and it's tough to bet on the U.S. housing market in 2026 unless we get what I'm suggesting. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at The Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time. Before we end today's show, stop what you're doing and subscribe right now to Real Estate Market Minute Plus. Listen to all episodes ad-free. Get exclusive bonus episodes and content and help support the show's growth, longevity, and future improvements. Go to realestatemarketminute.supercast.com right now. You can also find the link in this episode's show description. Check it out. I know you'll love it.